All right, I want to start on page 47, which is the Franklin Corporation classified balance sheet. Remember last time we were together, we looked at all of the current assets. This, of course, is the other side of that balance sheet for Franklin for October 31st. Liabilities and stockholders equity section. Notice liabilities are only broken into two classifications: current liabilities and long-term. And you also understand how important that 1 year mark is, right? So anything that, in this case for liabilities, these are debts that we owe or obligations that we owe. So if we owe those liabilities between October 31st, 2017 and October 31st, 2018, that's within a year, they'd be listed under current liabilities, okay? But if we owed a debt past that year mark, right? If it's due after October 31st, 2018, right? So the rest of 2018, all 2019, 2020, et cetera, then it would be classified as long-term liabilities or long-term debt. And that's based, I mean, this is going to be relatively easy compared to the assets because there's only two ways to look at liabilities. They're either due within the year, which makes them current, or they're due after the year, which makes them long-term. And again, that year mark is measured by the date on the balance sheet. Just remember the balance sheet has a very important heading that the date becomes critical in understanding what's current and what's long-term. So as you see here, current liabilities, these are going to be due within the year or within the operating cycle. There is an interesting pecking order to liabilities. It's a little bit different than assets, which have a real strong pecking order there in terms of how it's supposed to be listed. The only thing you need to know for liabilities is notes payable will be listed before accounts payable. Okay, that's really one of those odd things about it. But notes payable will always be listed first under current liabilities before accounts payable. So assuming they have any notes payable, they'll be there. So again, note, the word note in accounting, as you know, means loan. And so when it's a note payable, it has a due date, because this is a current liability. It has a due date within that year, right, because it's current. So whether it's 60 days, 90 days, 120 days, it has a due date. And it has an interest rate. A note being a loan means you're going to be paying interest on this loan, but we don't pay the interest until we actually pay the loan back. And we pay the loan back in one big chunk on the due date, which they call the maturity date. Okay, so that's how notes work. Accounts payable is basically any bill you have due within 30 days. And so that happens when you buy inventory or supplies, and they let you pay later. Right? You can take all the stuff with you and they give you a bill. Okay, that bill becomes an accounts payable. They want that money within 30 days. But the same is true if you got your, if this is your business and you got a bill from Central Hudson for electric and gas, right? Well, as soon as you get the bill, it becomes an accounts payable. That's going to be due within 30 days. So accounts payable is that general category of bills that are due within 30 days. Okay, these bills do not carry interest. When you get a bill from the Central Hudson, it's not a loan. It's not a loan. It's a bill. You've used this much electricity, and you owe this much for that use. There's no interest attached. So an accounts payable would simply be just a general bill, whereas a note payable has interest added to it, has a specific due date, and it's going to be due after 30 days. No, accounts payable are always due within that 30-day period. A very, very important liability, as you know, unearned sales revenue. Now, this is sales. So the word sales revenue means we're selling a product. We're selling physical goods. Whereas service revenue, which we see that at Sierra Corporation, basically is providing a service, right? You're paying someone to do some type of labor for you. So sales revenue means that the customers, in this case for Franklin, have paid Franklin Corporation upfront, and they're waiting for the delivery of the good, whatever they paid for. This might be considered, I mean, like a pre-order. If you have, sometimes they'll do video games or iPhones where you can pre-order them. You buy them up front, and then they literally owe you the video game or they owe you the phone. Well, it would be a current liability because you're not going to wait. You're not going to ask customers to wait over a year for a product. Although that's what Tesla literally did a couple of years ago, because it took them over a year to deliver a car. But for most businesses, they're going to need to pay they're going to need to fulfill that obligation to customers quickly. And so this is unearned sales revenue. The key word is unearned. See, if it was sales revenue, it would be not on the balance sheet. It would be on the income statement. And that would mean that it's already been earned. You've already delivered the product. So again, the word unearned becomes really critical in understanding this, because this is a sale that you have not earned, which means you haven't delivered the good. So once you deliver the good, of course, you can take the money. You no longer owe it once you deliver it. So then you can move it out of the balance sheet and move it over to the income statement as sales revenue in this case, because now it's earned. You've delivered the good. We've been over a couple of these already. It's always good to review because, again, the way you understand accounting is understanding the accounts. So all of these are individual accounts. They're worth the time. Salaries and wages payable. So payable means you owe it. Well, you don't owe workers anything until they actually complete the work week. So once you complete the work week and you put your time card into payroll, well, then now the business owes you for that work. Of course, they're not going to pay you until the next payday. In the meantime, that amount of money needs to sit on the books as a liability. It's a current liability because literally the company owes the workers that much money for the work that's already been done. It will be paid, of course, at the next payday. But then again, by the time the next payday rolls around, you're going to owe workers for the next week. So this is always open. This account is always going to be there. It's always going to be open because businesses, as long as they're surviving, are always going to have a payroll. And so they're always going to owe employees for work that's been done. So you'll always see this. The interest payable is a little bit of a different animal. Again, like I was mentioning, every time the company borrows money, say for short term, they have a note. They owe interest on that note at the time the note is due. The due date of a note, when you're going to pay it back, is called a maturity date. So on the maturity date, you're paying the whole loan back plus all the interest you owe at the same time. Well, you might have a note for 90 days, which is about 3 months, right? Well, you're doing your income statement every month. And one of the expenses you can take is interest on loans. So any amount of interest that you owe on a loan can be expensed in the month that you've had the loan, even though you're not paying it until later when it's due. And that's basically what interest payable is. It shows you how much interest the company has expensed because interest is is a cost of doing business, just the interest on the loan. So it can be expensed. Although they know they're not going to pay it until the maturity date of that note. So they're not going to pay it until sometime in the near future. That's what interest payable is. The amount of interest on loans that they've expensed, but they haven't yet paid. They will pay that interest when they pay the note. So that's, those two accounts are going to be related, you can say. Notice how current liabilities are totaled and put on to in the very far right column. It's important to understand that we also on the previous class talked about we needed to total current assets as well, right? So if we have total current assets showing on the asset side, we have total current liabilities showing on the liability and equity side. And this is important. So again, all of the classified balance sheets that you're going to be doing need to total current liabilities as well. All right, so again, current because they're due within the next year. They will be paid within the next year, a year from the date on the balance sheet. So long-term means that these are debts that are owed after a year, longer than 1 year from the date on the balance sheet. The word mortgage should indicate to you that the company has a loan on land or a building. Okay, so once a company has a mortgage is simply a loan on a piece of property. That's what they're called. And loans on property usually are very long. The 10, 20, 30 years. For you and I, as people, when we purchase a house at some point in time, and we get a loan to purchase that house, the loan is called a mortgage. And of course, people have those loans for up to 30 years. Okay, typically it's a 30-year mortgage, it's traditional. You can have terms that are shorter than that, but this is a long-term debt for sure. So there, again, the word mortgage indicates a loan on property. Here's an interesting question. Notes payable is listed here under long-term liabilities, and notes payable is listed here under current liabilities. Can anybody tell me why?
I think it's mostly because of how I think it really differentiates if the current liabilities has of notes payable is like at a bigger price, while the long term is like low priced. And that's why I can.
Less than a year.
Right. So it really has nothing to do with the price, Adam. I mean, we don't list things on the balance sheet based on how much we're paying for them. We list things on the balance sheet based on when they're owed. Time is critical. Okay. And so this particular note payable, which is $1,300, is not payable, is not due until after a year from the date on the balance sheet. Whereas these notes payable, this $11,000 that's listed here, is due to be paid within a year. That's the only difference. That's why, again, and you can have multiple notes. It's not like you just have one loan and that's it. You can have multiple loans. And so this particular note, this small portion here isn't due to be paid back until after a year. So again, that date is important. The date is super important. We're not talking about the cost of the loan, which is the interest rate. It's simply the date, Long-term liabilities are totaled up here. And then again, total liabilities are listed. Notice that all the totals for the categories are listed on the far right. Right? The total current assets are listed on the far right. The total long-term liabilities are listed here on the far right, and the total liabilities, which are current plus long-term total. So this is super important. Notice how stockholders' equity, there's no categories, there's no classifications. And of course, you always need to know that this is the order you will see stockholders' equity accounts listed on the balance sheet. Common stock is always listed first because in order for the company to become a company, the investors put money into it in exchange for shares of ownership. Remember, common stock simply represents the shares of ownership. Okay. And so companies begin with shares of ownership for cash. All companies begin that way. And so common stock is what the investors put in, okay, for shares. So it's always going to be listed first because that's how companies work. Companies have to exist for a while in order to make a profit. And so retained earnings are the retained profits, right? And again, the word earnings, profit, net income all mean the same thing. So companies had to be in existence for a while before they're profitable. And so retained earnings is listed second because simply it came after common stock. Literally, it didn't exist until after the company started. So again, common stock, owners put cash in to start the company in exchange for shares of ownership. That's what stock is, shares of ownership. Company exists, becomes profitable. Now you got some retained earnings. Okay, so that's why they're always in that order. Total stockholders' equity, as you see here, is listed and posted on the far right. And then the total liabilities and stockholders' equity is total, which is your total liabilities and your total stockholders' equity combined. So this $61,400 is these two numbers combined. Okay. So let's move on to your book has a discussion on and some examples for you. Again, the slides will show you that current liabilities need to be paid within the year. Okay. And that's really important. What's also important to note is even though you might have a 30-year mortgage payable, the portion that's due this year is actually a current liability, right? So you might have a 30-year loan, but the amount of money you owe that loan this year is current liability. Okay, so that's a very interesting little note here that is important. Here is the classified balance sheet for Google, but simply just the current liability section. And so it shows all of their current liabilities that are going to be due within the next year, right? And those are some other accounts that you will, accrued compensation and benefits is basically the same as salaries and wages payable, but you got benefits in there as well. So you'll learn more detail on these accounts as we'll go. Nike is important. These are long-term. Again, they have to. These are debts that are going to be paid with it after a year from the balance sheet. And Nike is interesting because it starts off with a very important term that you'll get to know called bonds payable. Now, a bond is a loan from investors. Okay. So you probably have all heard of the stock market because that's often what is talked about on the news. The stock market went up today, it crashed today, whatever. But what's equally important to the stock market, whereas where investors go to buy shares of ownership, common stock. And that's the only thing really for sale on the stock market is shares of ownership. Investors can also lend money. And they lend a lot of money to the US government. They lend a lot of money to state governments. And they lend tons of money to corporations. So investors who lend money to corporations, that loan is called a bond. Right. So if I'm a corporation, which Nike is, and I have bonds payable, that means I borrowed money from investors, from the bond market. As you see here, there's a notes payable on Nike's balance sheet that's long-term, which meant it's due after a year from whatever date is on their balance sheet here. Okay. So which of the following is not a long-term liability? Well, we just said bonds are loans from investors. These are long-term loans. Long-term notes payable are long-term liabilities. Mortgages are long-term loans. So the correct answer is the current portion of the long-term debt is due this year. So if it's due within this year, it's a current liability. So that's why B is the answer here on the slide. Stockholders equity, again, only two accounts to know and love here. Your common stock represents the investment by the owners into the company to start it, get it going. Retained earnings represents the amount of profit that's been retained, kept in the company. All right, so we're going to do a little exercise here. That's very important because one of the things you have to understand is that these classifications really, really matter. Once you look at an account, you should be able to classify it accordingly. And again, we learned that there were 4 types of classifications for for assets. Current assets, long-term investments, property, plant, and equipment, and intangible assets. And we just learned that liabilities are broken into current liabilities and long-term liabilities. Notice that there is no need to break up or classify stockholders' equity accounts. So we're going to be looking at a whole list of accounts, and I'm just going to be randomly asking you, and I have my roster here so I can call out names, of what you think it is once we see an account. However, if the account doesn't belong on the balance sheet, okay, then you can say it doesn't belong on the balance sheet, not applicable, or if you really want to get fancy, nah, because NA could be nah. Nah, can't be that. Okay. So it's totally up to you, but let's take a peek here. Salaries and wages payable. Marianne, are you here? And where would you put that? Marianne here? How about Annalise? No? Christian?
Hi.
Oh, hi, Annalise, how are you? How would you classify salaries and wages payable? I'm sorry? All right, so all right, so anybody? Jeanette, you want to do this?
Expenses?
No, it wouldn't be an expense, right? So salaries and wages payable, the word payable should tell you the type.
It would be a current liability.
Correct. So it's a current liability. Oh, shit. I gave you the whole thing.
Thank you so much for the info.
All right. Yeah, that's no problem at all. So this is a current liability because we just looked at salaries and wages payable. These are things that you owe your employees and you're going to owe them now. I mean, you're not going to wait over a year to pay your employees. No one's going to want to work for you. You're going to pay them on the next payroll. Once they do the work, you owe it. So it's a liability. But when do you owe it? Well, you owe it very soon. It's a current liability, right? Service revenue. Okay, Adam, where would you put this?
I think that would be in the current assets.
Well, when you look at the word service revenue, what type of an account do you think about?
NA.
It's a revenue account. It belongs on the income statement. And so this is not on the balance sheet. It's what the NA is for. It's NA just simply, it's not on the balance sheet, right? Remember, we have to learn the accounts and we also have to learn where they live, Service revenue is a revenue account. Revenue accounts live on the income statement. So that's why it's a not. Mhm. Eva, how about you for interest payable? What do you think?
Current liabilities.
Yeah, so interest payable, these are, again, interest that's already been expensed because they owe it soon. And that's going to be a current liability. Nice job. Okay. Let me see who else. Jeanette, I'm going to go to you next. Goodwill. Now, this is interesting because we haven't seen this account before. But Goodwill represents the additional value paid for assets by companies. I'll give you an example. You might know, you probably heard about Disney before. Sounds relatively familiar company. Several years ago, Disney wanted to expand their appeal to teenagers and preteens. So they bought Marvel. And then soon after they bought Marvel, they bought the Star Wars collection, Lucasfilms. Because a lot of those characters appeal to teens and preteens. And that was one of the markets they were soft in. So even though they might have bought $1 billion worth of characters, they paid much more than $1 billion for them. All the extra money they spent to buy that is Goodwill. So Jeanette, knowing that, where would you put this?
It's an intangible asset.
Right, it's an intangible asset. So intangible asset, and it's one of those interesting accounts. We're going to go into more detail in the future. Chapter 9 deals with assets in more detail. Sal, I'm going to go to you next. Depreciation expense. Where do you think that should go?
Would it be a long-term liability?
Well, we need to, again, that's a good guess. However, there should be a critical term here that you can recognize. As soon as you see the word expense in an account name, it should tell you that it's an expense.
Income statement.
Right? Rent expense, supplies expense, insurance expense, interest expense. That should tell you automatically it's an expense account. And so this belongs on the income statement, and so it doesn't belong on the classified balance sheet at all. So that's another one of those accounts. A mortgage payable. Mortgage payable. Madhuda May, how about you?
Long-term liability.
Yes, it's a long-term liability. So again, mortgage, the word mortgage is a loan on a piece of property. And in this case, it's due in 3 years, which makes it a long-term liability. Okay, great, nice work. An investment in real estate. Okay, an investment in real estate. So this basically means that a company purchased some land or a building. That's really all that means. So Megan, where would you want to put that? Let's go to Megan Yandel first. Sorry.
I would, an asset?
What type of asset would it be? It is an asset, but what type?
Not current.
Correct. It would not be current. So you've narrowed it down. You're doing your thinking, right? So you identified it as an asset, and you know this is not current. So then you have 3 classifications. Of the 3 classifications you have, which one would it be?
Long-term asset.
Yeah, it's going to be, well, it's a long-term asset, but what type, right? So you have long-term investment, property, plant, and equipment, and intangible assets.
Long-term investment. Sorry, I had a brain fog.
That's all right. Yeah, so it's a long-term investment account. Okay, it would be on the balance sheet, but they're not using this real estate right now. So they own it for the long term, but they're not using it. So that would definitely cancel out property, plant, and equipment. It's a tangible issue. Real estate is tangible. You can touch it. So it's not an intangible asset. It's got to be long-term investment. See, we just kind of narrow things down a little at a time. Okay, the other Megan. Equipment. Megan Elliott, how are you?
Equipment would be a long-term investment.
Well, it's a long-term asset for sure, but we have to assume that if you see the word equipment, they're using it. They're using it. So if they're using it, it's not a long-term investment, because a long-term investment is something that they own, but they're not using to generate the sales of their products or services.
Attention to the class. Thanks.
Okay?
So they would put it in people, plant, and equipment.
Yeah, PPE, property, plant, and equipment. You can't own people. Okay, that went away a long time ago. So it's property, plant, and equipment. So we have that. Okay. Yes, actually, and for those of you that will take economics at some point, human resources is not an asset, right? We rent labor. Businesses don't own labor. That's slavery, right? You don't own labor. You rent labor. Rent labor as a business. Okay. Next, accumulated depreciation. Sal, you want to tackle that? What do you think? Where do you see accumulated depreciation on balance sheets? Often right after the equipment account, right?
Is it like a long-term thing?
It's
Is it a depreciation?
definitely a long-term thing for sure.
All right.
But that's not one of the classifications we learned, right? So let's focus on the classifications that we learned. You guys have to know this.
It goes under people.
Cancel all your plans for the weekend. You need to know this. Okay.
I have a life.
Sorry?
I have a life, and I have stuff that I want to do, and I have to do,
Yeah, you have to do this.
I know I have to do this.
Okay. All right, Adam, no problem. So accumulated depreciation, Sal, where would it be?
I'm gonna go with long-term liability.
Well, it is a long-term issue, but it's not a liability. So what happens is once we use all that equipment, right? If I buy a pizza oven for my pizzeria, I'm hoping that pizza oven is not going to last forever, right? The more I use it, and the older it gets, the more wear and tear. Eventually, it's gonna crap out on me. Would you agree?
Yeah.
It's just like those delivery trucks for UPS. I mean, how many miles can you drive that truck before it dies on UPS? So they know that these long-term assets, property, plant, and equipment, is going to last for a certain amount of years, after which it's not going to have a use in the business anymore. They're going to have to replace that truck, or as a pizzeria, I'm going to have to replace that oven, right, if I want to stay in business. And so depreciation expense is the portion of the equipment that we have expensed in the year, and we keep track of all of that in accumulated depreciation. So if you looked at your balance sheet, you'll see accumulated depreciation listed right after the equipment account, which makes it a PPE account, property, plant, and equipment.
Oh.
Okay. Debt investments here, this is listed as debt investments short term. And I think we've seen this somewhere before. I'm pretty sure we have. Let's see. Trevor, are you here? Where would you put that, debt investments? How would we classify that? No, we're not. Are we ready?
Oh.
Yeah.
Current assets.
Okay. Who's?
I'm here. CA.
Yes. It would be a current asset, right? Because debt investments simply are short-term investments. We can cash these out at the end of every day, right? We can turn it to cash at the end of every day. It's in the current asset section of the balance sheet, and very important to know. All right, nice work. Thank you, thank you, thank you. Ricky, is Ricky here? Retained earnings. What type of an account is retained earnings?
Profit.
Oh, isn't that revenue? of some sort?
No, no. It is not a revenue account. Let's see. Anybody else?
Stockholders equity?
Right. So when you look, the stockholders equity section of the balance sheet has two accounts, common stock and retained earnings.
Oh, wow.
Right. So that's where it would be classified.
Okay.
Classified as stockholders equity account. The last one is unearned service revenue. And let's see, Damien, are you still here?
Yeah.
Okay, where would you put unearned service revenue?
Current liabilities.
Yes, it's a, right, it's unearned. So the customer has paid us for a service and we owe them that service. So it's a current liability. So if you don't like my chicken scratch, you can simply look in the book because all the answers are provided for you there. But this is good. I mean, this is critically important that you understand again, I'll mention it over and over again until it sinks in. In order to understand accounting, you have to understand the accounts. You need to be curious. When you see an account and you're not sure what it is, look it up, read about it, understand its definition, know where it belongs on the financial statements, okay? You should know that, you should be studying that a little extra by now, okay? That's very, very important. I can't tell you how important it is. But that's what you should be doing. What I'm going to do is I'm going to stop the share here. I'm going to bring you to Wiley. Okay. Wiley. To show you that, and I hope Wiley is working for me here because I've ignored it for a while. Here we go. So I want to just make this a little bit larger. Okay. So can everyone see Wiley on the screen now?
Yeah.
Yeah. Okay. So this was your homework from last class, Chapter 2, Learning Objective 1A. This homework is simply the current, the asset section of the balance sheet. Although I gave you through tonight to do it, you shouldn't be waiting for the last minute to do this stuff. Okay, I'll just be honest with you. You really kind of need to plan to study. Accounting, I don't think, is a very difficult class. It is very time consuming. Okay, it is very time consuming. I can promise you that if you sat down and you looked at the definitions of what service revenue is, or what notes payable is, or what debt investments is, you'd understand it. It's the time that's the critical part. It's the time that's the hardest part of this class. This is a time-consuming course. It's not like other courses that you might not need to spend a lot of time on and you do okay. You're not going to do okay unless you spend time in accounting. It leads to very good job opportunities to have this skill. And of course, you need a good knowledge base to do this type of work. And this is where it starts. Okay, I mean, I've been doing this stuff I've been teaching accounting for over 20 years. This is very, very important. You need to put time in. These are your homework assignments. I'm giving you the Chapter 2, Learning Objective 1 exercises that are going to be due by next class. Notice that this is due by next class because I want to review those with you. And then I've given you a problem set that's going to be due the following day, okay? It's very important that you learn how to do a classified balance sheet, that you learn where the accounts are going. This is time-consuming work, and so please put the time in, please.